Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market, from global macroeconomic trends to sovereign credit developments to regulatory and political changes.
Welcome to the Fitch Ratings Fixed Interest podcast. I'm Joshua Grundleger. Today we're discussing Canada, starting with the impact of dislocations in the oil market on sovereign credit quality. So Mark, it seems that the US-Iran war is dragging on a little bit longer than we originally expected. Fitch just updated its baseline oil forecasts. What are the changes and why did we make them?
Sure. Thank you, Josh. So Fitch raised its 2026 oil prices to $87 on a Brent basis or $80 WTI. And we also raised their 2027 oil prices to $65 Brent or $60 WTI. Our long-term prices remain unchanged at $60 Brent or $57 WTI. The update reflects expectations for a delayed reopening in the Strait of Hormuz, which we now assume takes place by July. If the reopening is delayed beyond that, or if there's more damage to energy infrastructure in the Gulf, we could see additional increases in 26 and 27 prices. Just as a reminder, Fitch's adverse case for 2026 is $100 a barrel, but we are not there yet.
So the sovereign and corporate teams use oil forecasts in slightly different ways. Can you briefly explain the differences?
Sure. So, within the corporate group, we tend to put more emphasis on the terminal year of the price deck, essentially the mid-cycle price. Mid-cycle prices are meant to be conservative relative to market indicators. That's to say they're meant to be stripped of any kind of geopolitical price premium. You can also think of them as the price a company needs in order to meet, but not exceed, its cost of capital. The idea on the corporate side is really we want to rate through the cycle. That's to say we want to avoid making pro-cyclical changes to ratings at commodity peaks and troughs, as we don't believe that serves anyone's interests. By contrast, for sovereign ratings, oil price is more of a macroeconomic variable that flows through the economy through different channels, including GDP, inflation, asset prices, and interest rates. I'd like to make an obvious point finally on this, but it is still worth mentioning. Higher oil prices are strongly positive for energy corporates in the short term. That's outside of any kind of demand destruction issues. And they're typically negative for sovereigns, although for an oil exporter like Canada, there can be some offsetting implications. Now, Josh, on that last point, maybe I can turn the tables on and ask you, could you discuss the impact of the oil price shock on Canada's economy?
Yeah, so in Canada's case, unlike many countries, particularly non-oil exporters, it's a bit of a mixed story. So most countries, you get a negative shock, higher prices feeds through to consumption. For Canada, I think given that they export, there's a bit of a positive that may offset some of these factors. That being said, it's probably all a net negative when everything is considered in Canada's case. Our baseline forecast for Canada right now, which is a March forecast, is 1.2% real GDP growth in 2026. Now, as you mentioned, our adverse scenario of $100 a barrel will take off probably 50 basis points from that 1.2% growth in 26. Since we're not quite at the adverse scenario yet with the revised forecast, we're looking at roughly in between that, although we'll be updating our forecast in June for our global economic outlook. So you can expect something maybe a little bit, 25 basis points more or less to be shaved off that. What I would say, though, is things are complicated and there's a lot going on in Canada at this time. Immigration has been a big issue. The USMCA renegotiations are coming up. So there's other factors that may play into a slightly different number going forward.
Okay. And Josh, you had mentioned, that there are offsetting factors that come into play for a country like Canada. Just specifically, what are the different economic channels that these are transmitted through?
For most countries, higher prices generally flows through and it directly will hit consumption and often slow the economy as a result. In Canada's case, these higher prices do flow through to the economy, but obviously there's this export side and an improved terms of trade that will really help Canada's economy in general. So we'll see that sort of positive offset some of these sort of negative price effects. What's actually kind of unique about Canada, and in our case, in the model that we use, is that much of the effect that we're seeing is actually going to flow through equity markets. The model estimates that those will get hit and actually cause sort of a wealth effect that will slow Canadian consumption. Now, I think there's maybe a little bit of an asterisk with this, in that equity markets have been volatile, but have generally been good since the Iran war began. So this effect might not be as pronounced as maybe the model suggests. And we'll have to sort of see how that plays out over the near term. It's also probably worth noting that, you know, we're talking Canada now in aggregate, but there's really meaningful subnational and, subsector sort of divergences within the economy that make the situation maybe a little bit more complicated. On that point, though, the oil and gas sector seemingly benefits the most from the shock. In your view, how is the Iran conflict impacting the Canadian oil and gas producers?
I'd say the lack of OPEC heavy sour barrels in the market has increased demand for Canada's main heavy sour crude grade, which is WCS, Western Canadian Select. It has also benefited the midstream by keeping Canadian oil exports relatively high and export pipelines full, with apportionment currently seen on the Canadian mainline pipe. Turning to growth, in terms of future growth, I'd say, the oil sands were in what I'd call a brownfield expansion mode prior to the Iran shock. We'd expect to continue to see cautious growth, although you could see some acceleration of this on the margin. In general, the dominant characteristic of upstream growth in Canada is it is constrained by takeaway and processing capacity. So maybe another way of saying this is you could see some moderate changes, but we wouldn't expect any kind of wholesale change in the growth outlook unless, new takeaway capacity comes in and or you've got, revised investor preferences in terms of shareholder growth versus shareholder distributions.
So do these developments have any M&A or other implications for the sector? What is Fitch's outlook for energy M&A in Canada?
I think the incentives for upstream M&A were probably already in place in Canada. This does probably add to them on the margin, though. So 2025 was quite a strong year. The incentives to merge are really all about creating scale and synergies by merging with adjacent operators. Plenty of examples that have taken place. Ovintiv's acquisition of NuVista and the Montney, Canadian Natural Resources acquisition of Tourmaline assets, probably most recently Shell's announcement that they were going to buy ARC Resources. And of course, if you wind the tape back a little earlier, you had Cenovus's merger with MEG. So all those incentives, they're still in place in 2026. What the Iran conflict probably adds on the margin is, perhaps a desire for increased diversification in terms of production and reserves. And I'm talking about geographic diversification. So I would think that the current conflict certainly could maybe help fast track future LNG expansions in Canada. For example, Canada LNG phases 2 and 3, maybe those come in a little faster now, that kind of thing. And the last point here is, just because Canada is oil sands dominant, it has particularly long-lived assets. So I think those are just generically attractive to any kind of company that's looking to replenish its tier 1 inventory. Josh, you had mentioned before that there are meaningful subnational differences, that's to say differences at the provincial level. How is the oil shock impacting the provinces?
Obviously, the energy exporting provinces, particularly Alberta, are going to benefit from higher oil prices. Alberta, in particular, as sort of the largest player in the oil and gas sector, is probably going to have substantial economic and fiscal benefits from this. The Alberta budget for this year, for instance, uses US $60.50 per barrel as their baseline price in their budget, which of course means they're getting quite a bit of a windfall as oil prices stay higher. In fact, their sensitivity that they included is about $680 million extra revenue dollars for every dollar above their benchmark that the oil price is. So you can do the math depending on where the oil price comes out for the year. And that's a pretty substantial windfall for them. The other oil provinces, Saskatchewan, British Columbia, Newfoundland and Labrador, will also benefit, but probably to a lesser extent, given that the sector is less of a driver of those economies. As for, the other provinces, Ontario and Quebec being the biggest, it's pretty much just a total negative for them. Essentially all they're getting over there is higher oil prices, and that's not usually good, as we said at the outset, for consumption. They'll see their economy slow a little, all else equal. There'll be certainly an impact on the manufacturing sectors that are important to those economies, as well as the fiscal positions. That being said, the provinces in general have conservative budgeting. There's been, quite a bit of uncertainty in the past few years, as most people are aware, particularly with trade policy and the upcoming USMCA negotiations. So worst case scenarios might see a deterioration, in the budget outlooks and how they actually play out this year. But we're not expecting that there's going to be too much of a deterioration at this point.
Okay. And, speaking of government finances, maybe could you characterize the impact at the federal level? I mean, a number of governments across the globe have kind of talked about, short-term tax or reg relief for higher fuels. Is the federal government in Canada doing anything to alleviate the negative impacts of the oil shock?
Yeah, so as of yet, they haven't done too much in Ottawa. The fuel excise tax has been temporarily suspended through September. That essentially saves consumers at the pump 10 cents per liter. Although there's some indications that some of this is actually being absorbed through higher prices and upstream by refiners. So maybe that's all not flowing down to the consumers themselves. This, I think, really kind of reflects both the short-term nature of the expected shock, as well as tighter fiscal conditions at the federal level. Deficits have been bigger. There are new expenditures coming down the pike, particularly with potential for increased defense expenditures, and debt to GDP has already been rising. So I think there's a little bit of a reticence to do too much. That being said, as this drags on and it starts to hit consumers and businesses, in their pockets more directly, you could see rising political pressure for more steps to be taken to sort of address these challenges. Depending on the measures and how they're implemented, it could alleviate some of the pressure on the economy. But of course, it comes at a risk of higher deficits and higher debt, which can potentially weigh on the credit profile going forward. What I did want to ask you, though, the federal government has been touting large infrastructure projects, over the past year under the Carney administration as a means to build the economy. In your view, will these programs have a meaningful impact on the energy sector, and can they sort of change the economic landscape there?
Yes. Well, look, the regulatory environment has definitely been a challenge in Canada. I mean, things like carbon taxes, historical difficulty in building out large energy infrastructure projects, uncertainty around long-term remediation costs for carbon capture associated with the oil sands. Those are things that have kind of been there that have been, impediments to kind of more rapid growth. It is true there's definitely a more constructive tone that's come from the Carney government around energy policy. I think two items in particular that they kind of talked about that could help benefit future growth. First is the streamlined approval process for, large projects. And the second, classic one is just increased takeaway capacity. And there are, things announced under both camps. We do see some execution risk around these initiatives, but we're generally, cautiously optimistic. So the attitude, at least from a corporate perspective, is let's wait and see how much traction they end up getting. And that certainly could lay the groundwork for a different growth phase for the industry. On the other hand, if they, for some reason, they don't pan out, we'd expect to continue to see kind of more of the same, which is, brownfield expansions taking place at a lower rate.
Well, thank you, Mark.
Thanks for having me, Josh.
And thanks, as always, to our listeners and viewers. If you'd like to learn more about Fitch Ratings analysis and views, please visit fitchratings.com and make sure to also subscribe to us on Spotify or Apple.
Subscribe to Fixed Interests wherever you get your podcasts.